guys, Joel Seach here, Harpel Financial Group, wherever you may be watching from. I hope you're keeping well, healthy and safe, and coping well and enjoying a bit of a return to normality in 2022. Though in the return to normality, just an update in terms of the latest. Mainly this video is about just the Ukraine and Russian tensions going on the other side of the world there on the outskirts of Europe. So I just wanted to give everyone a bit of an update in terms of how that impacts markets and just more broadly overall from a market and economic side of things, more so than an actual reasons around it. But some of the key points, I guess, to consider in this latest situation we've got occurring is Ukraine tensions have escalated with Russia, so ordering troops into the Ukraine regions has already occurred. Share markets are at risk of some more downside because of the fear of escalation and uncertainty around sanctions, but also gas supply to Europe as well, coming from Russia. And then the history, I guess, of typical crisis like these show that a short-term hit to market followed by a rebound over the next 3 to 12 months, depending on the severity of the hit. So, I'll come back to that just in a moment. So there's a few things, I guess, in terms of the current situation. Obviously, Russia now getting on the fringe of Ukraine and taking over some of the areas in occupying the Donbass areas. So there's a couple of different scenarios. So the scenario one, which looks like we're sort of past that, is Russia fully standing down just at the moment, which is we're now sort of in play of scenario two, which is Russia moving in to occupy those areas. And they're already controlled by the Russian separatists and sanctions from the West. So it's not so onerous in this scenario that Russia would cut off gas to Europe, but they could see a further hit to markets. But this is probably getting priced in already in terms of the market hit that we've already seen. So looking back in 2014, there's something similar that happened with Ukraine and Crimea as well. So that's a similar type scenario. Scenario three, which is the next one on from that, is the Russian invasion of all of Ukraine with significant sanctions and Russia stopping gas to Europe, but then potentially no NATO military involvement. This would cause a shock to Europe and potentially a lesser degree globally. Oil prices could rise and see a bigger hit to market. And then scenario four is invasion of all of Ukraine from Russia, and then with significant sanctions on Russia and gas supplies cut off, and then NATO military involvement as well, which would be more of a significant hit on markets. And albeit, I guess Europe's sort of already on edge, fully reverse that peace dividend that was happened in the 1990s at the end of the Cold War. So markets may take a bit longer to recover in that scenario. So there's sort of, I guess, some of the scenarios. Scenario two, as I mentioned, looks to be already on the way there. How far it gets into scenario two, time will tell. We really can't, I guess, guess in those sorts of situations. We just don't know where it'll go. But in terms of historical market patterns and what does it mean for investors? So, as I mentioned, we don't have a crystal ball when it comes to, the events around wars, and they're terrible for everyone involved. But from the point of investment side of things and markets and long-term to medium-term fundamental investment, what we sort of tend to see with just some dot points here is when we have periodic sharp falls, which we've all seen as investors over the years, and if we've been with Harpel over that period of time, we understand, and even as much as 2 years ago when we had a sharp fall with a pandemic. So even though it was different, obviously not being a war, periodic sharp falls occur in share markets. They're normal, they're healthy, but in terms of the long-term rising trend, ultimately it resumes, and shares provide that high term, and property and growth assets in general provide those higher longer-term returns, more so than the stable defensive assets. Selling out of growth assets in periods of uncertainty ends up being one of the worst case scenarios that can occur, because you're selling it in a period of fear and angst and worry and being emotional, which is generally not good when mixing with long-term investment strategies. So switching more or going to a more defensive approach can potentially lock in crystallized losses, and it makes it very hard upon the rebound to return that. And even just with confidence levels getting back into the market, it can really sort of stagnate. When short shares fall, obviously they're cheaper. So if we're still working, or if we're still able to add money into that space, that can really help with buying opportunities and putting money in as what we call dollar cost averaging. So when things come down or growth assets come down, properties come down, they're all things such as buying in when people are fearful and getting into a market that's down for a period of time. And when you're feeling a period of time when it's down like this and there's a lot of emotion and a lot of things happening, it's quite common to be worried or feel a bit of angst. That's quite normal in these sorts of scenarios. But the best way we try to help with our clients is to be unemotional about things and try to just make rational decisions around investment strategies moving forwards. Obviously, when shares fall, the dividends don't generally change too much, so there'll still be dividends coming in as well, and then other related assets also. So, in summary, sticking to a long-term strategy, an appropriate strategy, knowing that if history is any guide, with all the different things we've seen over the years, such as multiple different wars, Iraq, Afghanistan, terrorist attacks, 9/11, the Cold War, financial crisis, so on and so forth. These are all time and place events that we see in a period, in an isolation, in a vacuum. They'll cause that sharp downturn effect because there'll be that worry and that fear, and then as that starts to subside and things progress forward, and eventually things start to work their way through as human beings, that always occurs. Then we'll start to see that rebound and pick back up of companies and growth assets and whatnot, because comfort and confidence will start to come back into the market. It's just a period of time as to how long that takes. But if there's any further questions, feel free to reach out to us. We're always here and we're always keeping an eye on things and making sure that you're keeping up to date and well informed, but also mainly keeping confident and calm in terms of your situation to make sure that we're traveling along well and we're up to date with everything, and we'll keep you updated if there's anything that comes up. You take care, look after yourselves, and we will chat to you soon. Bye for now.